Hey there, Sats fans. Welcome back to Swan Signal Live. This is episode 81 with Lyn Alden and Parker Lewis, a dynamic duo who have never appeared in public before for a discussion like this. And that's what I love about this show, is bringing together great minds in Bitcoin and letting them have a conversation in public about whatever, Bitcoin and economics. And it's always fun to see the fireworks happen. I am Brady Swenson, your host, and I'd like to just shout out real quick Sam Callahan, who is a Bitcoin analyst on the Swan team. He does a lot of the research for the show and helps me prepare for it. So a lot of this product is his as well. And also the producer behind the scenes, Jacob Pope. Thank you to both of you guys for the value you bring to the show. Speaking of Swan, we have so much going on, and we're getting ready to launch so many things. We are in limited beta with several products like Bitcoin Benefit Plan, which is actually out there now. We launched with 4 companies in the LA area, and Voltage, you might know as the Lightning Network infrastructure company. They're all on board. They're giving their employees a Bitcoin benefit. So they're dropping $50, $100 a month into their employees' Swan accounts. And of course, those employees can access the full suite of Swan financial services from their account. We also are working on IRAs. We're also working on Swan Advisors. So this is like a dashboard, a tool, basically a service for financial advisors to procure Bitcoin for their clients' portfolios and manage it all from one dashboard. So working on tons of stuff, got an incredible team. And if you're looking, we have lots of openings for job positions to work on all of this amazing stuff. So you can go to bitcoinerjobs.com and check out Swan's listings, as well as over 100 other Bitcoin companies have listings over there, including Unchained Capital, which is Parker's firm. Now, there we go. Parker, welcome, man. How are you doing today? Hi, Lyn. How's it going?
Pretty good. How are you?
Good. Parker, I think you're muted. I wasn't sure if it was just me. Yeah. Okay. There you go.
That was me. No, thanks for having me back on, and look forward to having a discussion with you and Lyn today.
Likewise, man. Okay. So for those of you who don't know, Parker is head of business development at Unchained Capital, one of my favorite Bitcoin companies out there. Parker recently launched and his team, the Bitcoin Commons, which is a really cool community space in Austin, Texas for Bitcoiners. And he threw a great event there to sort of open up the space. And I was lucky enough to be there. Parker invited me, which was fantastic. Had a great time. And Lyn is head of Lyn Alden Investment Strategy. And I think both of these people will be familiar faces to most of our audience. Let's jump in to talk about price a little bit. I try to stay away from price action talk on this show for the most part, but this is some dramatic price action right now, and I think there's a lot of people who are feeling nervous out there. It's easier for those of us who have a lower cost basis, have been around for a long time, to sort of stomach these, plus we've been through them. But we also know how hard it can be when it's your first time kind of seeing this volatility. You can be told that they expect a lot of volatility. I could be expecting a lot of volatility, but that's completely different than experiencing that volatility. So let's just talk for a minute about price action here and where we might go and what we could expect. First one I want to ask about price is, what would happen if Bitcoin's price just nuked below 20K, that all-time high that held on for years? Where do you think that hodl floor is? Where's the leverage-free Bitcoin believer price base? Parker, you want to take this one?
Oh man, that's a hard one out of the gates. I think one of the best things about Bitcoiners is that they are great at catching falling knives. The market, kind of, when Bitcoin has volatility, particularly to the downside, when it hits critical levels, then liquidity forms very quickly. I personally don't expect that we'll go back through that level, just given how many weekends have already been shaken out, and really thinking about Bitcoin, given its supply can't be manipulated and its price can't be manipulated over a longer period of times because of that fact, that kind of being in this kind of sideways trajectory effectively for 18 months and having kind of two now 3 periods where it's really kind of come back to this 30,000 level. I think from a technical perspective, each time I think people probably would have expected that when it hit 30K, that there'd be a big technical bubble there. At least I think people expected that back this time last year when it retraced from 60 to 30 the first time, and it really didn't. There was strong support. Then back in January the same, and now we're seeing a lot of the same. So I don't think that other than psychological, that might be a significant level, but I don't think the psychology of it really dictates whether it's actually also a technical level that would cause forced deleveraging. There's nothing that I see in the market, but I'm not extremely close to following technicals, is that there's if there was a lot of leverage that was struck at like 20K, that it would create a technical move. But I don't think that there's a reason to believe that that's a magical level, other than people thinking that it's psychologically a barrier, which in my view doesn't actually drive big technical moves.
Makes sense, Lyn.
So I don't have a specific price level in mind, but basically one thing worth pointing out is that if you look at the historical, the PMI cycle, the Purchasing Managers Index, that's basically a measure of U.S. economic growth, and you can apply it to multiple countries around the world. And if you look at it over the long term, it looks like a sine wave. It kind of goes up and down every 3 years or so. And historically, Bitcoin has done very well in rising PMI environments. Economic growth is accelerating, and it's done rather poorly in economic decelerating environments. It's still a fairly new asset. It's volatile. And so even though some people don't treat it that way, the broad markets treat it like a risk-on asset, and risk-on assets tend to do poorly in that declining PMI environment. Now, historically, Bitcoin has bottomed before PMI bottoms. And so, we're kind of seeing an event here that looks a lot like what happened in late 2018, which was the last time we were in kind of the start of a declining PMI environment. And one thing I was theorizing about in the past few weeks was, if something happens to Luna, and I know we'll talk about this later in the show, but if something happens to Luna and they have to sell Bitcoin into a weak market, that could mark a capitulation. And unfortunately, that's what we did see. And so, it's hard to get more kind of messy than we are right now, but there are certainly other things that can be had. I mean, basically, I think right now we're in the stage where market participants have to go around and shake all the pegs and check, to see how far the contagion is spread in the broader, kind of crypto Ponzi industry, and get kind of clear out all the mess there. Now, I think longer term, a lot of that's going to bleed out more slowly, but I think they have to poke around and find out anything else that might kind of, erupt kind of in more volatility. So, I think there's a lot of buying pressure throughout the 20,000 and $20,000 to $30,000 range. I don't try to make a prediction about where like a quick wick price wick is going to go. But I think, right now we're seeing a lot of conditions that do look pretty similar to what we saw in the massacre of late 2018.
So, I mean, you'd say this is an accumulation zone. Anybody who's out there and feeling afraid or has any noobs that they've recruited or family members or whatever, now's the time to buy. I actually had a friend come to me and said he heard about this big, drop, and he's like, "It's now the time to get in." I was like, "Very good instincts." So yes, that's great. Yeah, so we are going to cover UST and Luna in the second half of the show. Corey Clipston's going to join us, CEO of Swan, and that'll be a good conversation. He's been on top of it kind of from the beginning and calling it out. And I don't think anybody thought that they would see the fall so quickly, but it was definitely being predicted by Lyn and Corey and others. Let's jump over to the macro scene a little bit. One thing we're seeing right now in the markets is deteriorating, economic conditions in general. We've had a large GDP miss last quarter with a drop of, I think it was 1.4%. It was expected to rise by a point. And a recession is defined as 2 consecutive months with negative GDP growth. So, Lyn, do you think that we're going to see an officially declared recession at the end of this month?
I don't know about the end of this month. So basically, one way to describe it is that whenever you have one of these declining PMI environments, that is, when you hit the kind of that bottom of around 50 or lower, you're basically in a near recession. And generally, it takes some sort of, catalyst to then push that into an actual recession. And if you look at, like say volumes of retail goods sold, compared to prices. So inflation's kind of masking some of the damage that's actually been done. We're already seeing lower volumes, and so I do think that there is considerable recession risk. I don't know if it's going to be this quarter. You could kind of hop along and have like every other quarter be recessionary and then small rebounds. But essentially, we're seeing declining economic activity across the board, and we haven't even fully been impacted by all those Shanghai lockdowns yet, right? So anyone who's seen those like satellite images of like thousands of ships all kind of clustered out the ports, all that's kind of disrupted, and that's still going to triple through the whole system, the whole like supply chain for months. And so, we're also seeing right now that on the eastern seaboard of the United States, they're very, very low on diesel fuel, right? So there's actually still really strong inflationary pressures, even though the demand side is weakening. And so we're in a very stagflationary type of environment, and whether or not we actually get like an officially called recession or not, I think that the economy is weak and it's going to continue to get weaker in the next few quarters.
Parker, any comments there? And then I have another follow-up.
Yeah, I think when I look at the macro picture, I focus less on GDP and what the underlying kind of economic activity is, not because I'm not cognizant of it, but everything is driven by the Fed. Because the Fed's credit system is the marginal price setter. And what the Fed essentially did from 2020 until earlier this year was inject nearly $5 trillion new dollars into the system, and that caused asset inflation at the same time where real goods and services that squeeze people's budgets, kind of puts a lot of pressure on general kind of household incomes and savings and the ability to spend in an economy. But now what the Fed is doing is raising rates. They are, kind of signaling that they're going to start to take liquidity out of the system. There are fewer dollars in the system and interest rates are going up. And ultimately, I don't think about short-term interest rates as actually increasing interest rates. The only way that the Fed really impacts the supply and the interest rates is on the supply side, I should say. And so they're signaling that they're about to start taking those liquidity building blocks out of the system. And the broader financial markets are front running them, both the equity markets as well as the credit markets. I pay attention more to the credit markets because that's, I think, at a fundamental more what the Fed pays attention to. They pay attention to risk premiums or the spreads between treasuries, which are also blowing out relative to corporate credit. Corporate credit is so important because those are companies building actual things in the real economy. And if you look at either the investment grade index or the high yield index, each of those indexes is trading like it's on near collapse. It hasn't collapsed like it did in March 12, 2020. But when you start to signal to credit markets that you're taking liquidity out of the system, you are on a head-on collision with breaking all financial markets. And that's what the Fed is on a path to do. And that they're going to probably, just like they did in September of 2019, they marshaled down the path of draining liquidity from the system until the credit markets broke. In that case, it was the repo markets. You don't know what credit market is truly going to break. The way that I define breaking is it when you see it, where there is no bid in a credit market and the Fed has to come in with emergency funding. And so when I think about GDP and CPI, it's like everything is levered to what the Fed is doing from a dollar standpoint. And right now, financial conditions are tightening significantly, which is going to drag down all dollar-based financial activity related therein. And the dollar is the international funding currency. So as the Fed goes, so goes the world. And it's just a matter of, it's not playing chicken. It's just the Fed is going to go down this path until financial markets go into free fall. And Bitcoin is ultimately a liquid asset. And so when you have liquid assets, all liquid assets become correlated to the dollar in short periods of time when the Fed is monkeying with the supply of dollars, and Bitcoin is uncorrelated over long periods of time because it is actually solving that problem. And so I think it's just people have to focus on the fundamentals and not kind of get lost in the sea of noise in between.
Thanks, guys. Sam just told me I said 2 consecutive months makes the recession. It's actually 2 consecutive quarters. Lyn was nice enough to just go ahead and correct it without saying anything to me, but Sam did. So CPI inflation rate came in today a little higher than expected, 8.3%. It was, I think, 8.5% last month. So Lyn, what do you make of this inflation print? And do you think that we're going to, I mean, is it temporary? Is it persistent? I know that you've been writing about this, but would love to hear you talk more about here.
So we've had a full year now of pretty high inflation levels. And once you get to a full year, kind of the monthly levels, if the month over month figures stop accelerating, like even if they stay elevated, if they stop accelerating, then year over year inflation starts to peak the way they measure it. We've already seen broad money supply peak and roll over, and now we're kind of seeing CPI start to peak. Now there's a lot of caveats there, right? So one is that that's not a perfect measure of inflation. Inflation is somewhat of a subjective basket. Everybody has their own inflation basket, and generally CPI will underreport compared to most people's inflation baskets. So we've seen, for example, there's more inflation in food and energy than in broad CPI. We still have the shelter component going up because the way they calculate it is pretty wonky, and that kind of follows with a lag. And so, we still have very stagflationary conditions, but you can have shortages mask inflation. Like I used the example before, I wanted to buy a new car, and I would have paid above asking price because I kind of need a car, a new one, and they just didn't have any of the models I wanted, and so I just didn't buy a car, right? So how do you measure that in an inflation basket, right? Basically, if those were available, if they had set prices more based on market demand, you'd see a higher inflation print, and instead it comes up into the category as declining economic activity. It's kind of like how back during the pandemic you couldn't get paper towels no matter what price you're willing to pay pretty much. Sometimes you just have shortages. And so I think for a combination of shortages and inflation, it'll be persistent, even though I think that, unless we get some more side shocks, the official year-over-year CPI is somewhat, peaking here. But if you see, for example, diesel completely run out on the eastern seaboard, that's very inflationary. If you see Russia completely shut off natural gas to Europe. That's basically there's all these kind of, these Boolean outcomes that can spike inflation even higher, right? So I think that the Fed is trying to basically kill the demand side because they can't really do much about the supply side. And Parker's right about the credit markets. So a lot of people ask the question, how far would stocks have to fall before the Fed reverses course? And that's asking the wrong question. It's what happens with credit markets under the surface, basically those other more fundamental things, because those are the things that, if they break, the whole financial system starts breaking very quickly compared to stocks that are they're farther outside of the center of the system. They're more on the periphery. And so, for example, in late 2018, when the Fed stopped tightening, it wasn't because the S&P 500 fell 20%. It was because the junk bond market completely went illiquid, right? So there's no junk bonds were issued for 6 weeks. And if you have a long period of that, you'll start to get company failures if they can't roll over debt and things like that. And then in late 2019, you had the repo spike. During March 2020, during that big sell-off, you had the treasury market go illiquid, right? So it wasn't even risky credit. It was just the fact that the dollar was spiking and the foreign sector had to start selling treasuries to get dollars. And so you had more sellers than buyers, and the market went totally liquid. People hadn't really seen the treasury market break like that before. And so basically, I think that the Fed's going to tighten policy until they either start getting obvious recession indicators or something breaks in credit markets or the treasury market. And we already see, treasury liquidity is getting worse. Credit liquidity is getting worse. And so we're already kind of shaking that. And the question is, how far are they going to try to push it until something kind of snaps them back to adding more liquidity? And basically, in that kind of environment, people sell what they can, not what they want to. And so anything that's kind of perceived as a liquid and volatile asset is prone to being sold. And so there's some places to hide out in cash and things like that. But even desirable assets are prone to these big sell-offs. So I do view this as an accumulation period, but I don't think we're out of the woods yet for inflation. And it's kind of this big trade-off between, if inflation's gonna settle down for a while, it's because the demand side's hurt, not because the supply side's improving.
It was great analysis. And in my mind, Lyn, it's like if you have the demand side being crushed or attempting to be crushed by the Fed, and then the supply side being crushed by shutdowns in China, for instance, then if from both sides, that's sort of the the worst case scenario, right, in terms of decreasing economic activity. Okay.
Sorry, I wasn't sure who that was directed to. Yeah,
That's
basically
okay.
yeah.
I
So
was ambiguous.
basically, if the supply side disrupted, you can't grow structurally, and we're not seeing much of a response to those price increases, right? So for example, we're not seeing a lot of new domestic oil production come online in response to high energy prices, and so a lot of the supply side is still constrained, and then so they're stuck in either a disinflation environment if they try to just keep killing demand regardless of what happens, or if they have to relent and start giving out, like, say, fuel subsidies or food subsidies and things like that, then you get a more stagflationary type of environment. And so, those can be very troubling for risk assets. But if you look at it as liquidity play, something that can hold up is, harder monies like, gold, Bitcoin, even commodities. The advantage they have is that they don't have margins, right? So any business is being squeezed right now because they're juggling their expenses compared to their revenues. Whereas something like Bitcoin's going down purely from liquidity. But if you get liquidity returned to the market and it's still a stagflation environment, that's when you could potentially see a decoupling.
Yeah. So Parker, we've talked a lot about the uncoupling over the years, and it does seem like this kind of an environment is where it might happen. Do you think that there's been enough kind of education laid, a foundation laid with, the big players in finance to perhaps have a decoupling where if we're in this stagflationary period or whatever, we might see financial entities and big businesses and high net worth individuals, et cetera, start to lead a charge toward starting to buy up Bitcoin in this environment?
Yeah, I think, I guess the framework that I think about is that in these periods where Bitcoin's price is sideways or down, that people who have been in the market are deepening their understanding, deepening their convictions, and reaccumulating. And that I think that if you went across the board, people generally do not adopt Bitcoin for the first time in these periods. That it's people who've been in the market that continue to educate themselves, understand not just the why, maybe the how, read more technical books, be paying attention more to what's going on around them, and start shifting more of their assets in their portfolio into Bitcoin, because they start to intuitively see it as money, and at the same time that's being positively reinforced by like absolute insanity from central banks all over the world, but also fiscal policy, whatever it might be, and that eventually that starts to soak up all marginal supply, which starts to force the price higher. And then new adoption waves happen more as a function of that washout ending and that reaccumulation. And that will be exacerbated as that's happening and as the Fed is forced to change course after they've broken credit markets, broken financial markets, and had to come in with even more QE than they did either in 2008, 2009, or in my view, than they have to do over the last 2 years. That each time they break the system is bigger in terms of the credit markets. The way that QE works is designed to actually cause credit market expansion, and that's also why they then need to print money. And through each one of those episodes, more people have the light bulb turned on. So your accumulation base of people that start to see or understand Bitcoin as money only increases as a function of time. But that's also recognizing that it is very difficult for new people to adopt Bitcoin when it's a falling knife or sideways. They just have less urgency, and I think that is deeply rooted in human psychology more so than it is anything about Bitcoin.
Yeah, I mean, that's human psychology, probably more difficult to overcome than the thing I was thinking was maybe we've had so much exposure and education, especially in the financial industry over the past couple of years, tons of discussion about what is Bitcoin, how does it work, what's its value proposition, all that kind of stuff. Lots of books come out and documentaries, all that stuff. At some point, it seems that that kind of education would help overcome some of these human psychological fears, but maybe it won't. Maybe it's just going to be a price action thing, and people will have to, jump in when they see a reversal in the trend.
I mean, I say that there are always exceptions to rules, and that I think what it will likely cause to happen over time is that when new people rush in, they're consistently going to be taking larger and larger steps, or that knowledge base curve accelerating. But it still is just in my own experience of the market going and educating a lot of people about Bitcoin and seeing kind of where people's heads are at over the last 3 to 6 months. That there is a function of when Bitcoin's price is down or flat, they feel like they have more time. They want to buy Bitcoin, but hey, I'll do it in a week or 2 weeks or a month or 2 months. And there's a lot of other shit going on in their lives. Their businesses are being squeezed.
Yep.
Their, their paper wealth is declining. There's a lot of uncertainty in the world. And, oftentimes I get this question when I'm explaining I explain Bitcoin as money. I often get this question that is, should I be thinking about Bitcoin as a monetary asset or as an investment? And it is a reality that the first time that somebody buys Bitcoin, they definitionally think about it as an investment. They can't see Bitcoin. You have to experience Bitcoin over time. You have to be observant to how it works. And that's not just about price. That's actually how the network works. That also makes you more in tune to seeing the world around you through a more clear lens. That people, the first time they are buying Bitcoin, they think about it as an investment, and it becomes money to them over time. And thinking about that does make it a decision that is more tied into the nature of their other assets. Someone's in the real estate business. Their real estate portfolio is getting squeezed massively right now by higher interest rates, especially if they need to refinance a building. Same is true of a restaurant that might be having their food costs rise significantly at the same time that people are feeling tighter budgets at home. And so I think that on the margin, yes, there's more education that's happening. And I think that when things start to turn, it will create more aggressive moves or quicker adoption. But there just is no avoiding that, I think in our world, Bitcoin is so intuitive to us as money, but that is impossible unless you have the benefit of a function of time. And that time really starts from the point that you first step kind of into the vortex off the ledge into the other side.
Yeah. Sorry, go ahead.
One thing I would add, and this could potentially lead into the Luna segment with Corey, but basically, the market has to go through this in order to shake out all the malinvestment in the broader crypto space. If Bitcoin only went up, right? If it was a low volatility move upward, you would see more and more leverage accumulate because you wouldn't have these wipeout periods. And anyone who just starts a new project, if liquidity is always abundant, those things just keep proliferating, right? And basically, there's no clean out events. Whereas these times where liquidity is drawn from the market. And to use, I think it's Warren Buffett's phrase, you see who's swimming naked, right? So when liquidity is withdrawn from the market, the Ponzi's break and all the pegs get tested and all the leverage gets, a lot of the leverage gets shaken out, at least the unproductive leverage, the irresponsible types of leverage, and that gets all sucked out of the system. And that's why you see over time, most projects don't last cycle to cycle to cycle because they didn't really have an innovation there to begin with. They didn't have that fundamental thesis that actually, creates an army of buyers. Whereas Bitcoin's the one that after every cycle, it ends up coming out stronger on the other side. And so, during a bull market, the risk to Bitcoin is that proliferation of altcoins and that diffusion of capital into all these different projects, and then it stops flowing into Bitcoin. Whereas during bear markets, obviously you have a risk to Bitcoin's price because of that liquidity being pulled out, but it's a bigger risk to the broader ecosystem. And at the end of the day, there's no way for Bitcoin to monetize unless it goes through these cycles and keeps kind of showing why every type of malinvestment is malinvestment until Bitcoin sucks out whatever percentage of the market it's eventually going to get.
So you mean this is the way that capitalism is supposed to work? That money is supposed to work?
Exactly. Yeah, basically
there's no intervention to get to bail out all the people who are over leveraged. All right, this is great because we're talking about, as Lyn called it earlier, the crypto Ponzi industry, and I'm going to bring up Corey now. Corey Clipson, he's founder and CEO of Swan Bitcoin, and has been talking about UST Luna for basically since the beginning. Lyn's been on the train as well, criticizing and warning about it when so many mainstream media outlets and VCs, et cetera, crypto influencers were out there cheering this on and trying to convince Bitcoiners to cheer it on as well. Welcome, Corey.
Great to be here. Good to see you, Lyn. Hey, Parker.
Hey, Corey.
So, Corey, I'm going to let you kick it off. Let's just lay the groundwork. Some listeners will have just heard about UST Luna in the last couple of days. So can you tell us what it does and who's involved?
Yeah, so very simply, and you should do your own research and read up on it. There's tons of Twitter threads and articles about it now. But essentially, there was a fairly run-of-the-mill altcoin scheme here. There've been a bunch of attempts to create an algorithmic stablecoin, which means not backed by collateral. Basically, just means that they set it up so that you can trade one asset, and that's the altcoin for the alleged stablecoin that's supposed to maintain its dollar peg, and that they would create arbitrage opportunities. Basically, like you can make money by maintaining the peg. Anyway, I'm going to kind of leave it there. But the point is that this is extremely easy to attack, extremely fragile, and is unlikely to ever succeed, because for something like that to ever succeed, you would basically see an abandonment of all of economic history. They've never succeeded in the long run. And you also need to solve the Oracle problem, which is not something that's been solved in computer science, regardless of what you might see from some altcoin marketers. So basically, I don't really care that much about altcoins, broadly, and don't dig into them much. But when something actually touches the Bitcoin space and Bitcoiners start talking about it, and, influential people with large audiences on shows start talking about something that is false. And I'd say, like, the last time that something kind of deeply offended me in that way was the fake invalid S2F models of Plan B, which were statistically invalid and should have just gone on the trash heap right out of the gate. My main thing is, like, I don't like it when influential Bitcoiners who are like on team Bitcoin and have a degree of credibility hurt their credibility. And so that's kind of the theme that to me connects those two. Is we had a lot of Bitcoiners pumping Luna, bringing Do Kwon on their show, palling around with like Novogratz and other people that were pumping Luna, on stage and things like that. And it's like, no, this isn't good for Bitcoin. And you should have learned by now that someone with a scam or a scheme, whether it's Stacks or Luna or something completely BS like Plan B, essentially just trying to get clout by pumping some fake models. Like, watch out! Don't fall for these things. So that's basically where I am. The whole thing collapsed over the last few days, and it was there are actually tweet threads explaining exactly how you could collapse it, and one of them was completely right. And it looks like Citadel actually executed the short, and it was straight out of the playbook of how you attack pegs of foreign currencies. Not even that hard to execute. So Luna is down from, I don't know, I think it was 75 billion market cap at its peak. It's 2 billion now, total rug pull. And the value of the UST peg, I think, bottomed out at like 22 cents. Jump Capital and Theros Capital and a few others are going to try to resuscitate it potentially. That's the line that they're saying, but it's really just a confidence game. Literally, that's what a con game is, right? It's a confidence game. And they're hoping that they can resuscitate it enough so that their, free or cheap Luna tokens that they got way back in the past end up being valuable enough that they can dump it on retail and kind of escape with some more ill-gotten gains. But I don't think that it's going to work, is my guess, because you can pull off the attack over and over and over again if it ever gets any market cap.
Can anyone explain the specifics of the mechanics of the attack? I'm curious.
Lyn, I know it, but if you know it, I've been talking too much. You want to just talk through what Citadel did?
You probably know it better than me. Basically, have we 100% confirmed it's Citadel? I think that's the.
I don't think we're 100% confirmed.
Yeah.
But
so,
okay, we'll just use them as the example.
Yeah. A large
sophisticated-ish firm with a lot of capital.
Yeah, and then basically they shorted Bitcoin. They got a lot of UST, and I think you go over this speaks more than me. But basically they drew in the liquidity. And then the problem with a peg is that if you know specifically how the peg is going to be defended, you know exactly how to attack it. And when you sell a lot of UST at the same time, that forces basically the entities that have to come in to defend it. And when they run out of capital to defend it, the way that the UST and Luna cycle works is that Luna is basically the equity that tries to backstop the UST market. And so when a lot of people want out of UST, if they start to fear that the peg is going to break, they start converting that into Luna. and then Luna starts, basically getting supplied, the Luna price starts going down. And while there's still market cap in Luna, there's a chance to reestablish the peg. That's what happened in their prior kind of peg moments. But when total confidence is lost and Luna itself starts collapsing, that's when the game's basically over. I mean, maybe they can salvage it at this tiny little level and do whatever they're going to do with it. But essentially, once Luna itself lost its value, the game was over. And then they can close their Bitcoin short. They might have also shorted Luna itself. And even if this wasn't attacked now, the problem is that if something can be attacked, it will be attacked. And so the more fundamental problem was that demand for UST was rather artificial in the first place. It was based on these artificially high yields that were supported by VC capital input. And so if you looked at the system, the reserves on that were being drawn down rather quickly. And so in a couple months, Anchor would have run out of money and either needs to be topped off or the yields would have had to fall in, which would have decreased the demand for UST. And so even without this attack, you would have had to basically either keep putting capital in to keep it going, or it would have died a slower death until it breaks one day. And instead, we just kind of ripped the bandit off and someone attacked it. But you might be able to describe it in more detail than I just did.
Well, it's interesting because I think what cued a lot of us to just say, like, a few months ago when, they started putting Do Kwon on these shows and trying to sniff around Bitcoiners and do the orange washing thing, affinity scamming, all we had to look at was, all the UST is parked in Anchor Protocol and Anchor Protocol has 20% interest. Like, obviously that's BS and not sustainable. So something rotten is afoot here. And it didn't take too much to find a few blog posts and a few tweets about exactly what's going on. And it's essentially these firms like Jump that are supplying the capital to keep topping up that reserve, and like the Luna Foundation Guard. So this is selling Luna out of their printed token pile, because only less than half of the total market cap was actually circulating. Most of it they just printed and kept for themselves. So they would just sell Luna out of their treasury essentially into the open market to fund this. They're just using printed tokens pumped up by a confidence game to buy that Bitcoin. That's weak hands, right? So the Anchor thing, basically any of these desks that owns a ton of granted or very cheaply acquired Luna, a lot of it is on a vesting schedule of like 1 year, 2 years, 3 years. And so they kind of have their dates of when it is, and it invests each month or something after the first year. They're all kind of in the monthly vesting now. So they're just looking at their spreadsheets and they're saying, okay, how much money do we have to commit? And this was going on way, way, way before the collapse. This goes back to like January. How much money do we have to commit to keep the Anchor Ponzi going, to get people to keep on staking their UST on Anchor so that there's no sell pressure on UST, so that we can keep on dumping our Luna tokens on retail and dumb funds that we basically got for free? So that was the game. They were happy to keep spending and topping up the Anchor Protocol and pump this thing as far as possible. We're very lucky that this thing got killed in the cradle. Not really. It was kind of a toddler. It should have died last year. It should have been killed in January. I think it was, frankly, Bitcoiners that actually didn't have their head in the sand and weren't just pumping false narratives that actually helped, display how you attack this thing, frankly. The Citadel or whoever did us all a great service killing it now instead of when it was 5 or 10 times bigger. Hopefully we learn a lesson. I'm really glad it died, and Bitcoin going down 10K is like well worth it to kill something like this and to show us the playbook to not fall for that crap again.
And the closest analogy is an emerging market central bank, which is how I analyzed it when I started to see people talk about it. Basically, there are a number of people for months now pointing out the risks with it, including Corey, who was super, aggressive going around pointing out the problems with this protocol. And so I looked at all the criticisms. I tried to look at the defenses to the criticisms, and I analyzed it myself. And you can map it out like an emerging market central bank, except that unlike a central bank, they have limited ability to capital controls, and they have no economy to tax to make it anything other than a first in first out type of thing. So when confidence is lost and people start selling the currency, the Luna, they basically sold their Bitcoin as the kind of like how an emerging market central bank would sell its treasuries or its gold to try to defend its peg or to defend the value of its currency. And when that runs out, there's really nothing left. Basically, you start to get a death spiral in the currency itself, kind of like what we've seen in Turkey and some of these other weaker currencies. And it's really no different than that. You don't have to understand the technical details to understand why it failed. I didn't look at the Luna code when I started writing about my concerns for it. It was entirely an economic observation based on the idea that UST demand was artificial due to the high yields, unsustainably high yields, and then analyzing the mechanism very similar to a central bank of how they would respond in the event of lost confidence. And so it wasn't really, there's detailed technical ways to attack it, but at the end of the day, it was an economic problem.
Yeah, I got a couple of things I want to point out because I followed this less closely, but I'm very sympathetic to whenever I saw some dude was pushing altcoins buying 10,000. I was like, that's not going to be good. 10,000 Bitcoin. But first and most importantly, did Mike Novogratz really get a Luna tattoo? Or
it's huge. It's
Yeah.
huge,
that
and it's
like
on his arm. No, it's real.
Yeah, so like somebody needs to go stick a microphone in Mike Novogratz's face and be like, dude, what were you thinking? And make that guy look like a fool. Two, if Citadel, which I'm not going to assume that is true, but if it was Citadel or somebody else borrowed 100K worth of Bitcoin, to like thinking about the market dynamics, to think that they're out of that position, I don't think is the right assumption. When you short 100K of Bitcoin and the price of Bitcoin starts moving down, Bitcoiners are great at buying falling knives. And that when Bitcoin drops, there is a lot of liquidity that forms to reaccumulate Bitcoin. And so trying to understand, like, was it actually Citadel? And are they actually out of the position? Because on the way down, there's a lot stronger hands accumulating and trying to get out of that position, and to think that they would potentially already be out, I think that would be naive to think. And that we could see an unwind of that position depending on how many Bitcoiners stepped in to reaccumulate between 40 and 30, because I think that it was just Citadel providing a backstop and not Bitcoiners being diamond hands and heroes. Will be interesting to see. Then the third thing, and I kind of like want to get y'all's thoughts on these, is third thing is Coinbase or any effing exchange that is listing these things. Like we saw what happened to BlockFi for issuing a yield account that on the relative spectrum like might have been skirting a few regulations, but like deposit here, we'll lend it out, people pay yield, and the SEC looked at that and said, hey, that looks a lot like a security that's not registered. You owe me $150 million. Like that was a massive SEC settlement. So in this case, if you just look at Coinbase, and it's like, I don't know if it might have been you, Brady, earlier, but you start scrolling down on the exchange, the number of things that are sold that are just like, I mean, it is penny stocks. It is penny stocks that are unregistered. And to think about, just on the heels of what Coinbase put out last night about, hey, customer deposits might be, tied up in a bankruptcy process, that when an event like this happens with Luna, where it goes down 95% because it was just an abject scam all along, that the people that help facilitate that liquidity, the exchanges, they have real exposure. And it's not limited to Luna, obviously, but thinking about the type of exposure that these are the type of things that catch the regulator's eyes. Obviously, Yellen, as much as I have a distaste and dislike for Janet Yellen for other reasons, kind of talking about this yesterday before Congress, that these type of moves are like, hey, let's go look at exactly what happened there. And it's not just going to go look at Luna. It's going to be the places that help facilitate the sale of unregistered securities. So just kind of like thinking about those, like beyond the technicals, those three kind of things are very relevant to, I think, how this ultimately plays out. And there will be skins to take and put up on the wall.
I take it you didn't load up on Universal Pet Income Coin when Coinbase said they were going to list it?
Not yet.
No? Okay.
Still sleeping on that one.
Why is it always pets that mark the top of these bubbles?
Yeah. Right.
What do we have against pets.com and Universal
People
Pet
like
Info?
pets. People
People
like
like
pets.
that. Yeah, it's true. It is an affinity scam in more ways than one.
Yeah.
Yeah. Any other thoughts on UST Luna?
I mean, I guess just one, because I've seen like the narrative that like Luna caused Bitcoin to go down, and it's actually funny that the mechanism was Bitcoin going down is what caused Luna to crash. Like that was the attack vector. Like once they worked Bitcoin into their scheme and said that there was going to be some kind of collateral there or whatever. At the end of the day, I think. It's like what Lyn was saying. Like, if you're going to do this, you have to conduct open market operations. So the real lie here was that there could ever be a decentralized stablecoin. There can never be a decentralized algorithmic stablecoin. It's a red herring. It's just something that they use to raise money and enrich themselves, basically, because it's obvious that you would need to conduct constant, ongoing open market operations with a centralized team, and you would have to be trying to like convince people to do things all the time and borrowing capital and doing this and that. Like you're recreating the Fed basically if you want to run one of these things. That's literally what it is. And so obviously it's a security. This is the same guy, by the way, that got served at that Masari conference last fall. So the SEC is already after him. He's also the same guy that created Basis Cash a couple years ago under a pseudonym, Rick Sanchez, which collapsed and went to zero, blew up $65 million of people's money with, an even worse experiment. This is backed by Polychain and Jump and Drayson, Galaxy, like the usual scoundrels. And again, where this is all headed, scam after scam, scam after scam, these people kind of trading in a lifetime of credibility because of this incredibly, historically short window of time when you can print money for free, pump your unregistered security with no repercussions, this window when it's not regulated. And it's the trade of a lifetime. And so you see people like Chris Dixon, just trading in all the great work that he did, with SaaS companies and marketplaces and backing AI companies and all this stuff. But it's like, they're going to get away with this and they're going to try to keep it going as long as possible. The only way for them to keep it going is regulatory capture. So they are in DC. Sorry, Niraj, they're in DC every freaking day talking about this, trying to like get this not regulated by the SEC, trying to influence SEC regulations. They're playing a please banks, please government, co-opt the heck out of crypto and proof of stake. We'll play nice with you. And that trifecta of banks and crypto funds, crypto infrastructure, all of them, and the crypto promoters and governments are actually banding together, inevitably, game theoretically, certainly, contra Bitcoin. They're not your friends. This is why we have to have our own industry organizations and our own talking points. And we need to understand this is not the time to buddy up to crypto people. They're the enemy.
Yeah, I completely agree with that sentiment. I do. There will be some joy in people burning their reputations. The risk is they will try to whitewash history. They will try to come back and say, yeah, we didn't know what was going to win. And, we were early on Bitcoin too. But there's people that should know better. And that it is really like it's like intellectual dishonesty. And then also there's a degree of it, which is intellectual bankruptcy. The people who are like, I'm not sure about Bitcoin, but stable coins are going to change the world. And it's like, whoa, like these people, like, there's a quote from Bull Durham: you couldn't hit water if you fell out of a fucking boat. And some of these are like the people that people looked up to 10 years as like, luminaries in venture investing. And so it will ultimately be a day where those people were proved to be horrendously wrong, some in a naive way, many in a dishonest way. And the critical thing will be the winners write the history, but they will try to whitewash history, and the Bitcoiners are going to need to be there to make sure that everybody remembers what actually happened.
This is good for Bitcoin.
Yeah,
There really is.
That's happened.
You know, and I do want to say that like traders are good for Bitcoin. OTC desks that provide Bitcoin for shorting are actually good for Bitcoin. Like that stuff is actually just capitalism at work and markets at work functioning the way they're supposed to. Like they hunt the weak players and the players with scams and schemes, and they hunt out those confidence games and take them out. And I'm happy to have them in the market. They make markets deep and liquid 24/7, which is what we need for Bitcoin.
All right. Fantastic cover of the UST and Luna stuff and crypto Ponzi industry in general, where we're going. So where we are going, the four of us are over to Twitter Spaces. There's over 1,500 of you or so, 1,500 of you now listening in on Spaces for the past hour. So we are going to hop over there and do a Q&A. So go ahead and start requesting to come up to the stage with your questions. It's a fantastic opportunity to talk to Lyn and Parker and Corey. So have those questions nice and tight so that we can get as many in as possible. All right, I'll let all of you, thanks Parker, thanks Lyn, thanks Corey, I'll let all of you head over to Spaces and I'll be there in about 2 minutes.
All right.
Okay, 2 and then 3 of the brightest minds that I know in this space. It's one of the reasons I love this show is being able to bring in such high quality guests. And if you go back through the archive, you'll find episode after episode, 81 of them now, with similar quality guests, fantastic conversations. A lot of it's evergreen. You can subscribe to the podcast and go through the whole feed at swansignalpodcast.com. In fact, we started this show during the massive wick down to like $3,800 or whatever it was in March of 2020 during the COVID crash. That's when we started the show. We were like, oh, well, everyone's kind of freaking out. We got to get on and talk about it. And we were on with about 5 or 6 of us Bitcoiners were on. And from then on, we just kept going every other week doing this show. So check it out. Subscribe on YouTube. Follow Swan Bitcoin on Spaces. And you'll be able to follow along for all of these shows. We also run a show called Cafe Bitcoin every morning from 9 to 11 Central time. So you have to convert that yourselves for your time zone, but 9 to 11 Central. And it's hosted by Alex Stanzik, and it's a great show. It's like to me, it's like morning drive time radio for Bitcoin. And there's a solid crew of 400 or 500 people that listen there every morning. And then depending on the guests who come in, might be popping at 100 at a K, like 1,000 or more. So it's a lot of fun. Check out Cafe Bitcoin, and I think you'll enjoy it. You can come up on stage and ask questions there as well. So I'll be over on Twitter Spaces in about a minute, and we'll get started with these questions. Thanks for